Simple terms, that's my topic. Next leg up, next week, next month, 10 years from now. I'm based in Vancouver, as you know. There's lots of these companies are based there, and there's lots of people that trade this stuff there. And I noticed through the last 2 or 3 weeks, a lot of the smart traders that I know have been selling. I mean, it's so ingrained among traders that we're going to have this huge pullback every spring. The PDAC curse, as we like to call it, although it's got nothing to do with the PDAC curse. It just happens that the spring period tends to be a weak one for bullion for a lot of different reasons based on the physical market. That gets exacerbated by the paper market. So you do tend to get these pullbacks, March, April, into May, in a lot of years, but they're not in every year. I've been a little bit hesitant to jump on the bandwagon, notwithstanding the way the last week went, and there's a couple of reasons for that. This is basically what we went through in the last year. The venture index is a terrible index for a lot of reasons, but it's probably the best analog that we've got still for juniors. And let's face it, all things considered, it was a pretty good year. For all the moaning and wailing and gnashing of teeth, you'd think last year was horrible. That was actually a better performance than just about any other market in the world put in. And yes, there was a pullback from July to back to December. The concern here, of course, is this last little pullback that we've seen in the last little while. A lot of guys that I'm close with that trade have been assuming that what we're going to get is something that's going to run through to the summer, where we'll see another 15 or 20% lopped off. That's certainly possible, but one thing that I think is worth pointing out, this is a 10-year chart of the venture index, ugly as it is, and it is ugly. One thing that I think is worth noting is, although it's commonly believed that the PDAC curse is an annual event, that's not actually true. The market actually behaves quite a bit differently. Like here's last year. Basically things ran through until well into June. There was a short-term PDAC curse, that was actually the bottom on the major exchanges in 2009. Look at 2010. You can't really call that a PDAC curse. 2011, there wasn't one at all. It doesn't really behave the same way in bear markets and bull markets, and I don't think there's much doubt that we're in a bull market again. So while I think there's room for a little bit more consolidation in the next month or two, I'm not sure I'd be blowing everything out left, right, and center as a lot of people are. I'm not convinced that we're going to have that big a pullback. A lot's going to depend on how the market reacts to a couple of things that I'm going to go into now. Obviously, the drivers are interest rates, U.S. dollar. Physical market doesn't really drive most of these metals much. They're really about trading and futures markets. So you've got to look at what they're being traded against. The dollar, the U.S. dollar, that is, pretty much did what I expected. It topped out in December. This trade got extremely one-sided. It's starting to get kind of one-sided again. This Trump/reflation trade is on a little bit again in the last couple of weeks, and the positioning on this still remains extremely long. Traders are very, very long the U.S. dollar, and these futures trades, they do unwind themselves. If there's enough demand, you can see the dollar keep moving. But the truth of the matter is, when these trades get one-sided, they tend to come back to the middle when the positioning's too one-sided. And so I think it's going to be a little harder for it to make that move through 104 than a lot of people seem to be assuming. This is TNX, which is a 10-year bond yield in the U.S. Again, topped out in December. You saw a move here in the last week, and this is sort of what's been concerning people, and that's based purely and simply on speeches by virtually every FOMC member, all of them basically pretty much saying they're going to raise rates in 2 weeks. I think at this point, if you look at this chart here, it's a chart that Bloomberg puts together based on rate differentials, and it's essentially the odds of a rate increase at the next meeting. You can get these charts for different meetings going forward, but I'm just looking at the March one here. You can see it's sat at about 30% all the way from the U.S. election until now. It's through 90%. As of today, it's probably more like 95. And to my mind, if you're an FOMC member, if you're if you're terrified of surprising the market, which they clearly are, I mean, the Fed are wimps, let's be honest. They really don't like to surprise the market. When you see the bond market pricing in that way, you're not going to get a better shot to raise rates and not have the markets get spooked. So frankly, if I was an FOMC member and I believe that we had to raise rates, whether I personally think that's a good idea or not, they're not going to get more of a green light than this. So I think we have to assume that they're going to do the rate increase. What's interesting to me and what's important, if you look at long-term movements in gold and silver, but other commodities as well, commodities in general, and this is something I harp on quite a bit in the newsletter. To my mind, it's very important. One of the most important indicators to forward prices in commodity markets and metal markets is not nominal interest rates, but real interest rates, and that's nominal rates less the rate of inflation. And this chart I'm showing you here was generated out of the Atlanta Fed database, and it shows two things. The black line here, that's basically the CPI. That's what they call the urban CPI. So that's the CPI for the major centers where they've done statistical sampling. The red line here is the 10-year yield, and keep in mind 10 years pretty far out. I mean, a lot of people that are trading, doing this sort of trading to trade inflation spikes, they're usually actually going to be using the 2-year note. So 10-year, we're going pretty far out on the yield curve here, and that's that yield less this urban CPI. And one thing that's quite interesting, if you look here on the end of the chart, this is basically the last couple of weeks, the real 10-year yield in the U.S. has gone negative for the first time since 2013. Keep this timing in mind here, where this bottom is, where it was at the most negative here in 2011. There's a reason why I'm pointing out that timing. If you take a look at a gold chart, and this chart compares real 10-year yields, basically what essentially the red line on the previous graph. That's been inverted on this. So basically this is an inverted chart, so the highest numbers are when the real yield is the most negative, and that's overlaid on gold prices. If you go back, this was that bottom I was showing in the previous chart. It's the peak here of real negative interest rates. Not surprisingly, that's the peak in gold prices. It's the peak in a lot of other commodities. There's a very, very strong negative correlation between real interest rates and commodity prices and gold prices in particular. One of the reasons I've been somewhat comfortable about the gold price, notwithstanding the fact that I do think the Fed's going to raise rates this year, that I do think we could see a bit more dollar strength, is because, and I'm going to go back here for a second, the reason why you saw these rates, why you saw real rates diving, is not obviously because interest rates are dropping that much. You saw from the yield curve it didn't really move that much. It was because of this. It's because the inflation rate started going up. We've seen that not just in the U.S., we've actually seen it even more in the EU. Right now, the base inflation rate in the EU is back to about 2%. A year and a half ago, everybody was running around freaking out about deflationary forces in that area. That seems to be past now. I think the combination of negative real rates will be supportive of gold prices going forward. I'm not expecting anything spectacular, but I'm not that concerned about a big dump in gold prices. And that's really all I'm looking for in the market that we're in. And we're already in a market where companies like the ones next to me here can raise money. I don't think for most of these deals you need to see skyrocketing gold prices. That would be nice, but what you need is enough stability that companies that can actually improve their fortunes through their own work will get paid for by the market. Very briefly, I just want to touch on base metals. Those have also seen a fair amount of strength. My favorite, and I've made no bones about it in the newsletter, is zinc, because it's got some real supply issues. There's really nothing in the pipeline. Glencore took 500,000 tons of production out a year ago. That helped kick off the bull market in zinc. Glencore's playing it pretty close to their vest, but as far as people can tell, and it's somewhat surprising really, Glencore has actually made more money producing 500,000 tons less zinc concentrate than they were a year ago because of the size of the move in the zinc price. I don't see those guys shooting themselves in the foot. I don't think that production is coming back anytime soon. Without that, I think there's a reasonably good chance in the next 6 to 12 months we see $1.50 to $2 zinc prices. I think that's actually quite a realistic possibility. Copper's actually done better than I thought it would. There are a couple of large copper projects coming on stream, but there's been so many supply disruptions this year, and some of those disruptions may not go away as fast as I initially expected. You've got things like Indonesia, creating problems for Grasberg because they want them to put them in the smelter. There's been a lot of strike activity in Chile. These kind of disruptions are common in the mining business, and they may actually make the copper price a lot more stable than I expected. I expected it to actually pull back a bit before it moved up. But the areas to watch for most base metals is really China and Europe. I mean, everyone's making a big deal out of Trump and the trillion dollar infrastructure. That's not really that big a deal. The U.S. has never. It's been a long time since the U.S. was actually the big marginal user of base metals. At a psychological level, it seems to be driving the market, but really China and Europe is where you got to watch, because those are the guys that actually use this stuff to a much larger degree. And again, these are warehouse stocks for copper and zinc. You can see they've both come off. I mean, zinc's been fairly steadily coming off for the last 4.5 years. Copper, you've seen some injections into it, but one thing I would note for copper, but even more for zinc, one thing I watch very closely is what's called the TCRCs, which is treatment charges and refining charges. Very few base metal producers smelt their own ore. They basically do contract deals with smelters. Smelters charge treatment and refinery charges, and the level of those charges gives you a pretty good indication of where the supply-demand balance is, essentially who's got the negotiating power. Lately, you've seen TCRCs drop from about $100 a ton on the zinc side down to about $20 a ton. They're apparently below $20 a ton for lead right now, and they've dropped down into the 60s for copper. What that tells you is that the smelters, who generally have the negotiating power in these deals, do not have a lot of negotiating power right now. They're having trouble getting concentrates, especially lead zinc. That's another one of the reasons why I think we're going to see more move in both of those metals, because there's just not a hell of a lot of the stuff around. It's getting very, very tight. This is just kind of blah 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 blah, but keep it short and simple. Yeah, you've always got to worry a bit about a spring pullback, but I don't think there's going to be that much of one. One thing that is important to watch in the U.S., we're in the midst of the renewal of this big Trump reflation trade, but I think it's important to point out that if you take a look at the economic stats in the U.S., most of the stats that have shown the largest improvement, the biggest surge, if you will, they tend to be survey-based statistics. So that's things like consumer confidence, purchasing manager indexes. These are all survey-based readings. So essentially, if people are feeling really good and Trump's got everybody pumped up, everybody's feeling very confident, you've seen the readings on those move up very rapidly. If you look at actual hard number historic readings like consumer spending, retail sales, GDP, so far at least, there really hasn't been a surge. There's some pretty major cognitive dissonance between the opinion about what the U.S. economy is going to do and the reality of what the U.S. economy is actually doing. So far, there hasn't been a growth surge in reality. I don't know whether the confidence that Donald seems to be engendering in the U.S. population is actually going to create the surge. I'm personally skeptical. I don't think the 3 or 4% growth that Wall Street is pricing into its projections and is pricing into its PEs is going to show up. I haven't seen anything yet that convinces me we're going to get an acceleration, so I would be a little bit careful about that. I think at some point there's going to be a bit of a reckoning where you're going to see the market realize these growth rates aren't accelerating. At that point, I think the odds of, not a crash, but a reasonable sized correction on Wall Street are fairly good, and that could come in the next 3 to 6 months. That wouldn't be the best thing ever for base metals, but that won't hurt precious metals, because certainly if you look at intraday trading, there's definitely been a lot of trading lately with gold against the S&P. There's definitely been an insurance trade side to it. I think that's the other thing that supported gold even when the dollar was moving, US dollar was moving higher lately, was you can definitely see an increase in the insurance trade, if you want to call it that. Which I think is sensible, because let's face it, I mean, the guy who's running this country to the south, he did a better job than anybody expected when he addressed Congress last week, but I mean, he's he's Donald Trump, folks. He's going to do something stupid. Like it's going to happen. I don't know what it's going to be. I don't know whether it's going to be next week or next month or 3 months, but it's going to happen. I just don't know what it's going to be. And I think it's completely logical to have a little bit of insurance for God knows what comes out of left field. And I think that's part of what's been supporting these things. So I think we're in a generally supportive environment. Like, yeah, we may get the PDAC curse, but based on the fact that we're early in a bull market, I think we've got that insurance rate supporting us. We're seeing long rates even in the U.S. go negative. Same thing's definitely going to happen in Europe. The real rates are even more negative. The other thing that I think might, help keep a lid on the U.S. dollar. I mean, you look at the U.S. financial press, and they tend to really be dismissive of Europe, downplay it. If you take a look at the hard, and I'm talking hard numbers, hard readings out of Europe, have actually improved quite significantly in the last 6 months. The European economy is actually doing a lot better than people seem to think it is in the last few months. The combination of that and the fact that their core CPI is back to almost 2%. The one thing you may also see happen in the next 3 to 6 months, Europe in particular still has a very high level QE program going on. The ECB is buying bonds like crazy to keep rates down. I think there's been word in the press already. You're already hearing German politicians getting quite nervous about this. They've never liked QE. They don't like the fact that they're doing this. They really don't have much reason to keep doing it based on the economic stats. I think there's real potential. You will see QE at the ECB level start getting unwound. If that happens, there's two things that come from that. One is it may actually push U.S. rates higher, because part of the reason why Treasuries rates have been able to be held down is that the ECB is buying so many bonds in Europe. They're basically buying everything in 2 or 3 of the country's bond portfolios. So the private sector, private funds have sort of been pushed out of that market. They're buying in the U.S. Treasury market because they've got to own something. Some of that demand may slacken off if ECB cuts back on QE, but the other thing it's likely to do is strengthen the euro. So I see a lot of reasons to think we're not going to see this big surge in the U.S. dollar. I'm definitely in a minority. I'll just have no illusions. I'm not giving you the majority opinion. Most people don't agree with me. But then, 15 months ago, everybody thought the U.S. dollar was going to 120 when I thought it was topping, and topping is what it did. So, I mean, I'm not too worried about being in the minority on this. I think we'll have a decent year. I think we got another year, early bull market year. It may be a little flatter than last year. I'm not really expecting that we'll see a repeat of last year, though that would be nice. But I think we've got an environment where companies that can deliver superior results and deliver growth are going to get the benefits, and they're going to get paid up by the market for it. And I'm about to introduce you to 3 or 4 companies, all of which I follow, except the guy in the end who you never know. I'm going to introduce them. First guys I'm going to introduce is Ron from GMV Minerals. GMV is a company I started following a little less than a year ago. I've actually known the management for a very long time. I actually found the project first because I was actually looking at metallurgical releases, which aren't the most exciting reading, I can assure you. But when you're looking for gold projects, if you can find one that's got very, very good metallurgy, which so far Mexican Hat does, that really lowers the hurdle. And I actually found the project first and then took a look at the company, and I didn't realize I knew the guys. And so we jumped on it last year when it was about 15, 20 cents. They've been delivering drill results. They should have quite good news flow in the next little while. I'm expecting more metallurgy, core holes. I'll let Ron go through it, but the project has changed a lot in the last little while. So it's a story that, although they do have a resource, they've got some real room for some very pleasant surprises on the upside and the exploration side, as I hope Ron will go into.